Assalamualaikum warahmatullahi wabarakatuh. Hello everyone. Here we are from Group 4 and we will present about a multiple paradigm science in accounting. Here are our group members and let's get into the material. The anthropological or inductive paradigm in accounting research is an approach that emphasizes understanding existing accounting practices as well as management attitudes and behaviors toward these practices. This paradigm does not start from theory but from observing reality, then drawing conclusions and building theories based on what is found in the field. Some researchers who are known as representative of this paradigm are Gilman, Hatfield, Idri, Littleton, and Patton. Now, we are going to result objective. As you can see here, according to Idri, this means the main objective of this approach are to understand current accounting practices, to explain the reason why these practices are used, to predict how these practices might evolve in the future, and to highlight changes that need to be made to the system, not to maintain the status quo, but to make the changes more relevant and applicable. And the next is research focus or subject. Researchers using the anthropological or inductive paradigm typically study about accounting practices that already exist in the real world, such as how companies prepare financial statements. And then management attitudes toward these practices, why they choose certain methods, what motivates them, and etc. This paradigm is highly conceptual and views accounting as part of a social and culture system that cannot be understood from numbers alone. The next theories in this paradigm. This paradigm includes the following theories. The first one is information economics. This explains how accounting information influences the economic decision of various parties. The second one, agency model. This analyzes the relationship between the principal and the agent and how accounting serves as monitoring and contracting tool. The third, income smoothing or earning management hypothesis. This examines how companies manipulate the timing of revenue and expense recognition to make financial statements appear stable. And the last one, positive accounting theory. This is a theory that attempts to explain and predict what accounting policies companies choose based on existing economic and political interests rather than because of what the rules should be. And then, research methods or techniques used in this research in the anthropological or inductive paradigm generally uses the following techniques such as income smoothing research techniques. This analyzes the company's profit pattern to see if the company intentionally smooths profit fluctuation. And then earning management research technique means studying how management manage profit for certain purposes such as getting bonus, maintaining stock prices. And the third, positive theory research technique. This tries to explain actual accounting practices from a political, economic, and managerial incentive perspective. The next material is about the true income or deductive paradigm. This is an approach to accounting research that is based on logical and normative reasoning. This approach starts from the ideal concept and basic principle of accounting, then builds a theory that should be applied, not what happens in the field. This paradigm focuses on creating normative accounting theory based on the concept of logic, rationality, and idealization of income measurement, not on empirical observation. The figures representing this paradigm include Alexander, Canning, Edwards and Bell, McNeil, Moniz, Spruce, and Sweeney. Most of them argue that income measurement should use one ideal valuation basis, not the historical cost system, which is considered absolute and irrelevant in economic decision making. And then, researchers who adhere to this paradigm focuses on first, formulation of accounting theory based on logical and normative principle, and the second, the concept of ideal income that does not rely on historical costs, but rather an approach that better reflects true economic value. Next is theories in this paradigm. The true income or deductive paradigm gave birth to alternative accounting theories that attempt to replace the historical cost system because it was considered not to reflect the actual economic condition. It include price level adjusted accounting or current purchasing power or CPP. This corrects the value based on change in the purchasing power of money due to inflation. And the second, replacement cost accounting. This valuing assets based on current replacement costs, not their previous purchase price. The third, the preval value accounting. The value of an asset is determined based on the loss that will be experienced if the assets were lost. And the fourth, continuously contemporary accounting. Continuous valuation based on current market prices. And the next, present value accounting. Assets and liabilities are calculated based on the present value of future cash flow. And the last one is net realizable value accounting. This means measuring assets based on the value that can be realized from sellers less selling costs. The next is about proponents of the true income or deductive paradigm. They use the following approaches. The first, analytical and logical reasoning. It's not an empirical observation. And the second one, starting from basic objective and postulates, then design, ideal valuation, and reporting methods. And the third, analyzing and proposing accounting theory models that are considered more accurate, relevant, and logical for today. In other words, they design an accounting as it should be, not based on what happens in the
True
field.
profit paradigm. The true or deductive profit paradigm is an approach in accounting that emphasizes the preparation of theories logically, normatively, and based on conceptual firmness. This approach does not simply following existing practices as in the inductive paradigm, but departs from rational and idealized thinking about how accounting theory should be developed. For the proponents of this paradigm, the main underlying issue is how to develop the concept of profit that is ideal and relevant to economic reality, especially in the context of assessing the company's net worth. Main characteristic. The first one, profit is not understood simply as the difference between revenues and costs as in the historical cost system. Second, according to Manuel, profit is an increase in net worth, and according to Alexander, economic profit is considered more ideal than accounting profit, although it cannot always be measured with certainty. And the last one, profit is considered to be an increase in net worth that reflects economic changes over a certain period. In general, five theories or schools of thought may be identified. First, price level adjusted or current purchasing power accounting. Second, replacement cost accounting. Third, deprivable value accounting. Fourth, continuously contemporary net realizable value accounting. And the last one, present value accounting. Each of these theories present alternative methods of asset valuation and income determination that allegedly overcome the defects of the historical cost accounting system.
Okay, now I will explain the theories in the decision usefulness or decision model paradigm. The decision usefulness paradigm focuses on how financial information can aid decision makers such as investors, managers, or other stakeholders in making a rational decision. Theories in this paradigm are grouped into two main categories. First is theories related to business decision-making models, and theories related to economic events affecting business continuity. So the theories related to business decision-making models are related to various mathematical or quantitative models used to support business decision. The example include one EQQ or economic order quantity is a model to determine the optimal order quantity that minimize inventory and ordering costs. PERT or Program Evaluation and Review Technique is a project management technique for planning and controlling project completion times. Third is linear programming, is an optimization method to maximize or minimize an objective function subject to certain constraint. Next is capital budgeting. Capital budgeting are the process of evaluating long-term investments such as purchase of fixed asset or new project. The last for this example is buy or lease decision is an analysis to determine whether it is more beneficial to buy or lease an asset based on long-term cost and benefit. So the second theories is theories related to economic event affecting business continuity. These theories focus on major economic events that can significantly impact a company as a business entity. These examples include bankruptcy, takeovers and merger, and bond ratings. The bankruptcy is analysis of how companies face the risk of financial failure. Takeover and merger is studies on the process and impact of corporate mergers or acquisition on company's value. The bond ratings assessment of a company's credit risk by rating agencies such as Moody's or S&P. Next is a method in the decision usefulness or decision model paradigm. This method used is in this paradigm are oriented toward empirically testing financial information to assess its usefulness in decision making. The key aspects include use of empirical technique and discriminant analysis. Use of the empirical techniques is proponent of use historical data and statistical method to evaluate the extent to which specific information is useful in making prediction or decision. So discriminant analysis is a technique for classifying objects or companies into certain groups based on their characteristics. The example application include classifying companies as healthy or high risk based on financial indicators such as debt to equity ratio, cash flow, and net income. So the financial information from each company is analyzed to determine patterns that can help decision makers understand the condition of the company and the market as a whole. Okay, next is decision usefulness or decision maker or aggregate market behavior paradigm. This paradigm extends the focus from individual decision making to aggregate market behavior. The key point of this paradigm include focus on aggregate market behavior. This paradigm seeks to understand how financial information affect overall market behavior, not just individual decision. For example, are how do income statement affect stock price in the capital market as a whole, and can be how do change in accounting policies influence investment levels in a particular sector. So this research form an important foundation in this paradigm as they explore the relationship between accounting information and capital market behavior empirically. So in this paradigm, this focus is on how information is used by market participant as a investor or analyst to make collective decision that reflect the condition of the market in aggregate.
So the next material is the decision usefulness decision maker aggregate market behavior paradigm. The examples of the decision usefulness or decision maker or market behavior paradigm are the works of Gordons and the Gunness and the Poch. Gunness extend the interest in decision usefulness from the individual user response to the aggregate market response. Connects developed the aggregate market paradigm, which implies the accounting procedure number have informational content dictated by market response. In their award-winning paper, Connects and Depots provided a theoretical framework for assessing the desirability and effect of alternative accounting procedure. Their approach relies on the use of price of firm ownership shares. Connett and Poach conclude that the price domain analysis is sufficient for assessing the effect of alternative accounting procedures. Next is image of the subject matter. To those who adopt the decision usefulness of decision maker or aggregate market behavior paradigm, the basic subject matter is the aggregate market response to accounting variables. The author who adopt the paradigm agreed that in general, decision usefulness of accounting variables can be derived from aggregate market behavior. Theories in the paradigm. The relationship between aggregate market behavior and accounting variable is based on the theory of capital market efficiency. According to this theory, the market for securities is deemed efficient in that market price full reflect all publicly available information, and by implication, market prices are unbiased and respond instantaneously to new information. Theories confirming the market behavior paradigm include the efficient market model, the efficient market hypothesis, the capital asset pricing model, the arbitrage pricing theory, and the equilibrium theory of option prices method in the paradigm. Those who accept the market paradigm rely on the following methods. first is the market model, the second is the beta estimation model, the third is the event study methodology, the fourth is the loss valuation model, the fifth is the price level balance sheet evaluation models, the sixth is the information content of earning model, and the last is the model of the relation between earning and return.
Next material is the decision usefulness or decision maker or individual user paradigm exemplar. The decision useful or decision maker or individual user paradigm emphasizes the importance of accounting information in helping individuals make decisions. The main focus in how user or individual users respond to accounting information in their decision making. In this paradigm, it is hypothesized that the relevance and user of accounting information depends on how users understand accounting itself. The model developed describes the factors that influence whether a decision will be affected by accounting system and information. In essence, this paradigm sees that the use value of accounting information comes from human behavior, how they understand, interpret, and use it in making decisions. So, the main subject of this paradigm is the reaction of individuals to accounting variables, not just the data or the system itself. Next is theories in the paradigm. In the decision useful individual user paradigm, the theories used are generally taken from other fields to explain and predict human behavior in the accounting context. These borrowed theories include cognitive relativism in accounting, cultural relativism in accounting, behavioral effect of accounting information, linguistic relativism in accounting, functional hypothesis and data fixation, information inductance hypothesis, organizational hypothesis and batteries like, contingency approach to accounting system design, participatory budgeting and performance, and human information processing models. Next is models in the paradigm. In the decision useful decision maker individual user paradigm, the approach used to build model usually follows behaviorist method. The goal is to understand how individuals respond to accounting information in real situation. Models in this paradigm are often built using first, observation, directly observing user behavior towards accounting information. 2. Interview, exploring user understanding, attitudes, and the reason for using accounting data. 3. Questionnaires, collecting data from many individuals to see patterns of response to accounting information. 4. Experiment, testing users' reaction in controlled situations to see the effect of certain variables. These models emphasize how information is used in decision making, not just the information itself.
Next, we have the information or economics paradigm, which views accounting information not just as numerical reports or administrative records, but as an economic commodity that carries value, cost, and benefit. Information is considered valuable if it can improve the quality of decision making and ultimately enhance overall utility. This paradigm emphasizes that not all information needs to be provided, only the information whose economic value exceeds the cost of producing it. This approach is closely related to decision theory and economic theory, which form the foundation for designing and evaluating accounting information. This paradigm consists of two main approaches: the individual case and the multi-individual case. The individual approach focuses on a single decision maker, for example, an investor who uses financial statements to choose the best investment option. Meanwhile, the multi-individual approach focuses on the interactions between two or more parties, such as managers and shareholders. This approach is closely linked to agency theory, team theory, and incentive contract theory, where financial statements serve as tools to manage relationships and reduce potential conflict of interest. The methods commonly used under this paradigm involve analytical approaches based on statistical decision theory and Bayesian analysis.
In practice, researchers and accounting professionals use these methods to assess the value of information by evaluating how much it can reduce uncertainty, improve decision accuracy, and lead to better economic outcomes compared to other alternatives. Additionally, this approach applies cost-benefit analysis to determine whether an accounting information system is feasible and worth implementing. The strength of this paradigm in its logical and measurable way of evaluating information. However, it also faces certain challenges, such as the assumption that all economic agents act rationally and the difficulty in accurately measuring the costs and benefits of information. Therefore, this paradigm should be viewed as one perspective among many rather than the only way to understand. So that's all the material from our groups. We apologize for any mistakes in our delivery. Thank you and wassalamualaikum warahmatullahi wabarakatuh.